2026 is going to expose who owns gold and silver as a firewall and who just rented the story for a rally, rates and risk assets, without being forced to sell the one thing you bought as insurance. Safe means your hedge works when your emotions don't. Safe means you have a plan that survives the market. That's favorite trick, turning normal volatility into panic selling. And that's exactly what happens at the calendar turns, year-end into January, when liquidity thins, positions reset, and the crowd mistakes mechanical flows for new information. That's where the real pressure starts. Right now, the calendar itself is a catalyst. Year-end profit-taking hits, funds rebalance, options roll, hedges get reset, and the market tests where real demand lives. People think the story is gold up because fear. That's the headline. The mechanism is uglier and more useful. Who is forced to buy, who is forced to sell, and who can't source metal when it matters. And here's the first thing to lock in. Even if the metals thesis is correct, price can whip around violently. It can drop fast, hard, and stupid. It can do it at the worst possible time. And it can still be bullish. That sounds contradictory until you understand market structure. Futures and options don't care about your narrative. They care about collateral, margin, and hedging. When gold has a year like 2025 and finishes up something like 60% plus on the year, and silver posts a triple-digit percentage gain, the entire ecosystem changes behavior. Traders get bigger, leverage gets bolder, positioning gets crowded. And the exchange doesn't reward crowds, it taxes them. A margin hike is not a conspiracy, it's risk management. But it has the same effect. It forces the most levered holders to shrink. And when forced selling hits into thin liquidity, the dump looks like the top is in. That's the psychological weapon. And if you don't see it coming, you confuse noise for signal and you sell the hedge right before you need it. But that's not the part that matters. The part that matters is the hidden detail that reframes the entire gold and silver conversation. For 2026, and it's not a meme, and it's not a chart pattern, silver has been formally treated as strategic supply chain infrastructure. It's now recognized in the US as a critical mineral. Read that again, slowly. Silver is no longer just a precious metal story. It's a critical input story that changes incentives. It changes how governments and industries think about stockpiling. It changes how procurement behaves under stress. It changes what shortage means. Because a shortage in a strategic input is not allowed to clear the same way a normal commodity clears. That's the kind of detail the mainstream will mention once and then move on, because it doesn't fit a clean narrative. But if you're building safety for 2026, it's central. Because when something becomes strategic, the demand function becomes less price sensitive at the wrong time. And that's when the paper market and the physical market start speaking different languages. And that's where the real trade begins. So let's talk about the simplest but most misunderstood mechanism, paper price versus physical pressure. The headline spot price is discovered primarily in paper, futures, forwards, ETFs, and derivatives. It's liquid, it's fast, and it's where large players manage risk. But physical metal moves through mining, refining, fabrication, logistics, and inventory systems that don't bend on a dime. Lead times are real, bottlenecks are real, refining capacity is real, recycling responds with delays, and some inventory is effectively non-deliverable for price discovery, even if it exists somewhere on a spreadsheet, because it's not in the form, place, or ownership structure that can meet immediate demand. That's what people mean when they talk about deliverable versus non-deliverable inventories. And here's why it matters this week. When paper selling hits, profit-taking, margin calls, option dealer hedging, the paper price can drop quickly even while physical tightness remains. That divergence doesn't show up in headlines. It shows up in spreads, premia, and the term structure, and that's where the signal is. Everyone watches the spot chart. But the market whispers the truth in the curve. When the market is comfortable, you often see contango, future prices above spot, reflecting financing and storage. When the market is stressed for immediate metal, the curve can flatten or flip. Backwardation, tightness, urgency. I'm not promising you a single curve shape on command. I'm telling you where to look for the pressure. Because if physical demand is real, it leaves fingerprints, tighter spreads, elevated premia in certain products, strange regional dislocations, and a curve that stops behaving politely. And if that's happening while headlines scream sell-off, you're watching the shakeout mechanism in real time. But there's another force that can make moves look fake until they suddenly unstoppable. Options. This is where this move isn't emotion, its math becomes literal. Options dealers manage risk dynamically. When large open interest clusters around key strikes, the dealer's hedging can create feedback loops. Here's the clean version. If dealers are short calls, they may need to buy futures as price rises to stay hedged. The buying can accelerate the move. If dealers are long gamma, hedging can dampen moves. The point isn't the jargon. The point is this. The market can mechanically create sudden accelerations or sudden air pockets around strikes and expiration windows, and you will misread it as someone knows something. And sometimes nobody knows anything. Sometimes the market is just clearing risk, and if you don't respect that, you overtrade your insurance. That's where the damage happens. Now, let's build the proof stack, because one argument is not enough. We're not doing faith. We're doing layers. Layer 1 is price context itself. Gold finishing around the $40,300 area after a massive year tells you two things at once. One, the trend signal has been up in a way we haven't seen in decades. Two, the market is now vulnerable to violent pullbacks because so many participants are sitting on gains and so many risk managers are watching the same crowded door. That's not bearish, that's structure. Silver printing record highs in the 80s and then sliding back into the 70s is the same story with more torque. Silver is a higher volatility instrument with an industrial heartbeat. It doesn't drift, it whips. That means if you treat silver like gold, you get emotionally kidnapped. And that's where people blow up. Layer 2 is institutional flow behavior. Institutions don't buy coins from your local shop. They buy vehicles and they buy exposure. Strong inflows into precious metals vehicles, ETFs, and similar products are a real demand channel because they create consistent price-insensitive buying in size. And they reinforce the narrative loop that pulls in more marginal demand. If those flows stay constructive into early 2026, it matters for price discovery because it tightens available float and it changes how dips get bought. But if flows reverse, it matters too, because a reversal can feed a fast downdraft in paper price, even while physical demand is fine. That's why you track flows like a grown-up, not to worship them, but to understand the marginal buyer. And the next detail flips the whole setup. Central banks. Central bank buying isn't a meme, it's reserve management. It's a slow, stubborn bid that doesn't panic sell because of a scary candle. It tends to respond to regime questions, currency credibility, geopolitics, sanctions risk, and long-term purchasing power. When gold has a year like 2025, central banks don't automatically stop. Some accelerate, some diversify, some pause. The point is that the buyer set is different than in a normal retail-driven spike, and that changes the shape of drawdowns. Layer 4 is on-the-ground symptom. Look at what happens when prices get extreme in major demand centers. Demand doesn't disappear, it shifts form. Jewelry demand can soften as price rises, while bars, coins, and investment vehicles gain share as people stop buying pretty and start buying portable. That's a behavioral tell. It's the market telling you this isn't just fashion, it's balance sheet anxiety. And that matters because it speaks to the kind of buyer that shows up on pullbacks. Layer 5 is supply chain reality, especially for silver. Silver is often produced as a byproduct of other mining operations. That means supply does not simply surge because price is higher. The system is constrained by the economics of lead, zinc, copper, and other primary production streams. Add refining and fabrication constraints, and you get a commodity that can look abundant on paper while feeling tight in the channels that actually deliver product. That OUS, exactly where critical mineral framing becomes dangerous for bears, strategic stockpiling and industrial procurement don't always wait for a perfect price. They wait for certainty of supply. And when certainty is questioned, they buy. They pre-buy. They lock contracts. They front-run their own risk. And that's where the squeeze risk starts. Now, I'm going to say something that will save you money if you can tolerate it. The title question is not answered by a single number of ounces. Anyone giving you a magic ounce count is selling you comfort. Safety is portfolio specific, liability specific, and horizon specific. But we can still answer it cleanly with a framework that forces honesty. Here's the test. What are you insuring against? If you can't name the risk, you can't size the hedge. For most finance-minded retail investors, macro watchers, and metals people skeptical of institutions, the real risks cluster into 3 buckets. Bucket 1 is currency purchasing power drift, slow bleed that doesn't feel like a crisis until it has already done its damage. Bucket 2 is policy and rate regime whiplash, cuts, hikes, liquidity injections, liquidity drains, and the ripple effects across asset prices. Bucket 3 is tail risk, geopolitical shocks, banking stress, capital controls, or localized currency stress that forces people into real assets fast. You don't need all 3 to happen for metals to matter. You need one. And that's why metals are not a trade for many people. They're a layer. But the layer has to be sized to survive its own volatility. So instead of how many ounces, start with how many months of essentials. You want your hedge to cover in a high stress scenario without forcing you to liquidate at the worst time. That sounds basic, but it's lethal in its honesty, because it forces you to confront liquidity needs. If you have 0 cash buffer and you load up on the most volatile form of the hedge, you are not safer, you are more fragile. And fragility is the opposite of safety. Here as a practical way to think about making the cut in 2026 without pretending we can predict exact outcomes. Think in 3 bands. Band 1 is baseline defense. You want enough exposure that if purchasing power erodes and risk assets wobble, you have a stabilizer that isn't someone else's promise. This band is typically modest relative to total assets, but it's real. Band 2 is serious hedge. You are explicitly protecting against currency stress. And regime shift, and you accept that you might look wrong for months because you are not chasing immediate gratification. Band 3 is hardline insurance. You are prioritizing resilience over optimization. You want a meaningful chunk in assets with no counterparty risk. And you're comfortable with opportunity cost because you value robustness. The percent ranges people use to describe these bands vary widely, and you should treat any one-size-fits-all allocation as suspicious. But the concept is stable. Safety is a function of how your hedge interacts with your liabilities and your temperament. And that's where silver and gold separate. Gold is the balance sheet hedge. It's the steadier shock absorber. Silver is the torque. Silver can outperform violently in certain phases, especially when industrial demand tightens and investment demand piles in, but it can also punish you with deeper, faster drawdowns. So the sizing rule is different. If your goal is safety, gold generally carries the primary insurance job, while silver is the higher volatility satellite that can add convexity if you can emotionally and financially tolerate the swings. And the next detail is what flips many people. If you overweight silver because it's, say, cheaper, you often end up underinsured because you can't hold it through the volatility. Cheap is not the metric. Survivability is the metric. Now, let S talk market structure in a way that directly answers how much without giving you a fake personalized prescription. Separate your metals exposure into 2 mental sleeves. Sleeve 1 is the core hedge, the part you do not touch because it exists to protect you from regime risk. This sleeve should be sized so that a brutal, sudden drawdown does not force you to liquidate. That means it must be compatible with your cash buffer and your time horizon. Sleeve 2 is the tactical sleeve, the part you might rebalance, add to on dips, or trim into spikes based on signals. Most people accidentally turn the core hedge into the tactical sleeve. They buy the hedge and then manage it like a day trade. They sell when it scares them and buy when it feels safe. That is the opposite of insurance. Insurance is purchased before the fire. So, do you make the cut? You make the cut in 2026 if you can truthfully say 3 things. 1, you have enough liquidity and runway that you will not be forced to sell metals into a volatility event. 2, your core metals exposure is sized for resilience, not dopamine. 3, you know what would invalidate your thesis, and you are willing to adjust if the tape tells you you were wrong. That last part is crucial because skeptic of institutions doesn't mean blind believer in one asset. It means you respect incentives and evidence, and that's what we're doing here. Now, let's address the emotional manipulation explicitly because this is where a lot of people get quietly farmed. The market will use volatility against you even if you're right. It will slam price in illiquid hours. It will pair a red candle with a scary headline. It will make you feel late at the top and stupid on the dip. And it will do it repeatedly, because repeated emotional whiplash is how positions transfer from weak hands to strong hands. The defense is not ignore everything. The defense is having a noise versus signal filter before the move happens. Here's a simple one. Noise is a fast move that is not confirmed by the underlying pressure indicators. No meaningful change in the physical market feel. No clear shift in flows, no lasting change in the curve, no genuine break of key structural levels. Signal is a move that is reinforced by the pressure indicators, persistent flow behavior, tightening that shows up in spreads and premia, and price structure that holds after the shakeout. You don't have to be perfect. You have to avoid panic decisions. If you want one sentence to remember in 2026, it's this. A correct thesis can still produce a painful drawdown. And that drawdown is often the admission price for the next leg. But that's not a license to be stubborn. It's a reminder to be structured. So what should you watch right now, today, this week, into the first couple weeks of 2026? First, watch the obvious levels without worshiping them. For gold, the low $4,300 region is an immediate battleground simply because it ES where the year ended and where profit-taking showed up. A clean hold and rebound suggests dips are being absorbed. A decisive break lower can trigger momentum selling and mechanical de-risking, especially if it coincides with risk off elsewhere or a sudden dollar squeeze. Below that, the big psychological zones, round numbers like $4,000, matter not because they're magical, but because that's where behavior changes. Stops cluster, option strikes cluster, and headlines amplify. If you see signs of tightness persisting while price wobbles, that is often constructive for the medium-term thesis. If you see tightness easing while price rallies, that can be a warning that the rally is more paper-driven and vulnerable, and that's where the real pressure starts. Third, Watch the behavior of forced participants, margins, collateral, and positioning. After a monster year, it's common for exchanges and brokers to adjust margin requirements. That doesn't mean manipulation. It means the system is trying to reduce tail risk, but the effect is real. It can cause a sudden flush that feels like a narrative break. If you're levered, it can end you. If you're unlevered and structured, it can be an opportunity. So the rule is simple. Don't use leverage for your insurance. If you want a tactical sleeve, keep it separate and sized as money you can afford to have whip around. Fourth, watch institutional flows in metals vehicles as a weekly pulse, not a daily obsession. Strong inflows can reinforce the bid. Sudden outflows can accelerate paper selling. Neither is destiny, they're tells. They tell you about the marginal buyer. Fifth, watch the real-world symptoms, premia, availability, and procurement chatter. You're not looking for one dramatic headline. You're looking for persistent friction, delays, tightness in certain products, unusual regional price differentials, and industrial demand that doesn't blink. If silver's strategic framing is real, you'll see it in the way industry and policymakers talk about securing inputs and in the way procurement acts when uncertainty rises. And that's the hidden detail that makes 2026 different. Strategic commodities behave differently under stress. Now, let's make the how much question painfully concrete with a simple coverage lens. I'm not telling you what to buy, I'm giving you a mirror. Step 1, list your essential monthly outflow: housing, food, utilities, core obligations. Step 2, choose a runway you want protected from worst-case forced selling. 3 months, 6 months, 12 months. There is no universal right answer. The right answer is the one that lets you sleep and prevents panic liquidation. Step 3, decide what portion of that runway you want covered by your hard hedge layer versus cash and other liquid defenses. Metals are not an ATM. They're a store of value and an insurance layer. Your cash buffer handles immediate needs. Metals handle regime risk. If you try to make metals do both jobs, you end up selling them at the wrong time. And then you're not insured. Once you do that, the ounce question answers itself as a consequence of your liabilities, not as a superstition. That is why the ounce count gurus are dangerous. They skip the liability side and sell you a fantasy of certainty. Safety is not certainty. Safety is robustness. Now, here's the part you need to hear if you are the kind of viewer who prides themselves on skepticism. Skepticism without a plan becomes emotional trading. The market doesn't care that you distrust institutions. It cares whether you can hold a position through the exact volatility designed to break you. If you want to be safe in 2026, you need one more tool: a two-scenario lens. Scenario 1 is the controlled pullback and retest. This is where gold and silver dip, headlines get smug, and everyone starts declaring the trade dead. Liquidity is thin, a couple big players take profits, maybe margins tighten, and price stabs lower. In this scenario, the bull case stays alive if key levels hold on a closing basis, if dips get absorbed, and if the pressure indicators don't collapse. This scenario is where disciplined builders add methodically, not emotionally, if it fits their plan. Scenario 2 is the continuation squeeze. This is where price doesn't give you the dip you deserve. Silver runs back toward prior highs faster than feels rational. Gold punches into new territory. Liquidity thins. Dealers hedge. Shorts scramble. The move becomes reflexive. In this scenario, the risk is not being wrong. The risk is gap risk and volatility. Price can overshoot, then snap back violently. This is where chasing with size can wreck you even if the trend is up. The discipline in scenario 2 is resisting the urge to turn your insurance into a FOMO trade. And the next detail is what flips the whole setup. Both scenarios can happen in the same month. First the squeeze, then the flush, or first the flush, then the squeeze. That's why safety is not about calling the path. It's about surviving the path. So what would weaken or invalidate the metals as safety thesis as we move into 2026? Not a one-day sell-off, not a scary headline. The thesis weakens if the macro regime shifts in a way that restores real yield dominance for an extended period. If the demand channels that supported the move, central bank accumulation and institutional flows, reverse meaningfully and persistently, and if physical tightness signals ease in a way that suggests the supply chain is no longer stressed. The thesis weakens if gold can hold important structural zones after multiple attempts and starts trending lower in a sustained way. The thesis weakens if silver's industrial demand narrative cracks, if procurement backs off, if substitution accelerates, if a recessionary impulse crushes industrial offtake faster than investment demand can replace it. You don't need perfect prediction. You need a plan for evidence. Because if you don't define invalidation, you'll rationalize anything, and then you're no longer an investor. You're a captive. And that's exactly what volatility is designed to create. Now, I want to bring this back to the title in one clean sentence. You are safe in 2026 if your metals position is large enough to matter in a regime shift, but small enough that you can hold it through a brutal drawdown without forced selling. That's the paradox. Too small, and it doesn't protect you. too large, and it destabilizes you. And silver's critical mineral status is the hidden accelerant that makes this balancing act more important, because it increases the odds that physical realities can collide with paper positioning at the worst time. That doesn't mean guaranteed moon. It means higher variance. It means more moments where the market will try to convince you wrong right before it proves the thesis. And if you can't psychologically survive those moments, you won't benefit from being right. So here's your next week checklist, concrete and simple. 1. Track where gold and silver are relative to the year-end battleground zones. Do they hold and base, or do they crack and cascade? 2. Watch for signs that the move is being driven by paper churn versus persistent demand. Flows, curve behavior, premia, and how price reacts to bad news. 3. Pay attention to calendar mechanics, option expiry windows, month-end rebalancing, the first liquidity return in January, because that's when the market reveals who's real. 4. Keep your core hedge separate from your tactical impulses. If you want to trade, trade small and separate. Don't trade your insurance. 5. Decide in advance what would make you reduce risk. Not because of fear, but because the evidence changed. That's how you avoid being emotionally manipulated. And if you want a subtle litmus test for whether you're built for this, it's simple. When price whips, do you feel the urge to do something immediately? If yes, you're overexposed or underplanned. Fix that before the next wave hits. Because 2026 isn't about being the loudest bull. It's about being the last disciplined participant standing when the market uses volatility as a weapon. Now, the final thought. If you're still listening, you're not here for hype. You're here for mechanisms and truth. That is the kind of community that actually makes the cut. People who can hold two ideas at once. Metals can be a rational hedge, and metals can still hurt you on the way to being right. If that's you, drop a comment with your own definition of safe for 2026. 3 months, 6 months, 12 months of coverage. And the one signal you'll watch first when January liquidity returns. Not because anyone needs to copy anyone else, but because disciplined thinking is contagious. And it's the only edge most retail investors can actually keep. And remember, the market will try to make you confuse noise with signal. Don't let it. Build the hedge you can hold. Track the pressure where it actually shows up. And treat 2026 like what it is. A stress test for conviction, not a beauty contest for predictions.